Why don't you kick us off and give us some thoughts on what you see happening in real estate these days?
Awesome. Thanks, Tony. Thank you, everyone, for joining. I'm Ryan Boykin, co-founder of Atlas Real Estate. And, of course, we have Tony and Julianelle, our CEO, on the line with us as well. Atlas Real Estate is a services company that helps people with property management needs, helps people to understand rental real estate as a vehicle for investing and creating opportunity for the long term with the purchase of real estate. We help people to purchase and sell their homes. And we also help a couple of bigger companies such as Zillow and other institutional clients to purchase their portfolios of single-family real estate and be a partner with them in their journey. So that's a little bit about Atlas. For those of you that have joined this before, I'm going to try and say that every time. It's a little bit of a mouthful. Purpose of the call here is that we want to opine and understand real estate in today's environment and what it looks like in the coming months and coming years. And increasingly, we have a better idea of what that looks like. And so we'll get into those details. Quick update on collections. I know that a lot of people are curious how collections are going for a company such as ourselves. We manage about 3,200, 3,300 properties, I believe, in our geography, which is in Colorado and Arizona, primarily Phoenix, Denver, Colorado Springs, and Fort Collins. Astonishingly, I checked the numbers. It's probably been about 5 or 6 days. But 5 or 6 days ago, we were only about 1%, almost 2% behind our normal collections rate from the historic norm. We'll call that prior to March. And I was just so pleased to see that. I've done a bit of industry research, and I've compared that number to other property management companies. And then there's been all sorts of surveys that have been done from the multifamily industry that have indicated what collection rates have been for other folks that are outside of the Atlas ecosystem. And on this call, I try not to boast too much about Atlas, but I got to say I'm really pleased with this number, and I have to give a giant note of gratitude to our property management team, to our resident resource manager, and even all the way through to the vendors and the residents that have all supported this effort. To be only 1 or 2% behind our historic number is really, really impressive. To compare that nationwide and on other asset classes, pretty much across the board, I'm hearing numbers more like 5 to 8% below the normal average, and that depends on state, that depends on asset class. I've also heard that Class A apartment buildings are in the 4% category, while many Class C apartment buildings are as bad as 20% here locally. So there's a lot of variance in that number, and of course, our portfolio is only our 32 or 3,300 units and homes that we manage, but I thought that was a nice data point, and once again, a great thank you to our team. Second thing that I just mentioned is that leasing right now is quite strong. I'd say that our leasing activity and our success in leasing vacant units is just a hair less strong than it was this time last year. Of course, we're in the hot spring and summer season right now, so we would expect leasing to be strong in a normal environment, but it continues to be quite strong right now. I don't think that we're capturing quite the rent increases that we might have in prior years, and in fact, we're giving recommendation to most of our owners that the right thing to do right now is to try and keep rents stable. There's almost a little bit of headline risk associated with telling a tenant, hey, we're going to increase your rent, and everybody is losing their jobs, and there's just not nice optics around that. So our recommendation to our owners is that we try to keep rents stable and get those renewed. And then when we're leasing a property fresh, well, we can choose our rent rate and try to get whatever we can get and be patient or be aggressive. One other note that I think is really encouraging, you have two sides of the picture. On one side, 30 million people in the United States are unemployed right now. A devastating figure, and we're going to talk a little bit about what that means to the economy in this venue on this call. But on the micro level, I did want to mention that Atlas Real Estate is hiring right now. So if you and your network know of anybody that would be interested in a property management position, we're going to be hiring at least 2 people in property management in our company in Colorado right now. And I think that we may also be looking for other real estate specialists, be it an investment specialist, be it a home specialist in our brokerage side of our business. I think that we're going to start looking towards that as well. And for those of you that may not know, all the people that work as brokers, as real estate agents underneath the Atlas umbrella, the vast majority, almost all of them, are actual employees as opposed to a 1099 independent contractor. And that's a decision that we made a long time ago to try and put more focus and invest more of what we know into the individuals that choose to hold our name as a part of who they are, and that we really want to entrench the knowledge that they have in real estate so they can be the absolute expert. And in order to do that, you want to have a greater level of shared and mutual commitment among that individual and among the company. And so that's kind of our philosophy on that, as an employee, we can garner a greater commitment and a greater long-standing relationship. It goes back to, we try to make decisions that are very long-term oriented, and we're willing to take the short-term effort that's required to train and some of the financial and the resources that need to go towards it. So kind of a nice little data point in terms of what's going on the micro level with Atlas, and that there are companies out there that are wading through this environment and hopefully bringing on new personnel. So that's a little bit on the update side of things. I have one other kind of interesting update data point. Tony, you brought this up to me this morning. I'm curious if you could share with the audience a little bit. Do you think that right now might be an attractive time to refinance your personal home, your primary residence?
Yeah, I think it might be. So, you know, I keep a little bit of a finger on the pulse of the mortgage business, and rates now have trended in some cases below 3% for 30-year fixed rate mortgages. That is historically low, even in 2003 when we saw the lowest rates that we had seen, you know, since rates had been tracked since about the 1950s. They never got below 3%. So there is an opportunity now in the market to borrow money for 30 years in the twos. And that's, I mean, there's probably a financial commentary there as well, Ryan, that we could get into. But if you have Fannie or Freddie loans that are that you have a term left on them. So in other words, if you've got 10 years left on your term, you shouldn't probably be looking at doing anything. But if you have a longer term Fannie or Freddie loan, now would be a good time to consider refinancing. And we're happy to make connections to the lenders that we work with. If that's helpful to you, you may have a lender that you've worked with in the past. I will say that you're not going to find those rates at large banks right now. So one of the ways that large banks are going to contain their volume is by using interest rate to slow down that volume when rates get really low like this. So there is probably going to be some work to find that rate, but it is out there and may present a great opportunity for people.
That's awesome, Tony. I'm not usually in the refinance game too much, and he mentioned that to me, and I'm going to check in on my primary and see what we can do to do a refinance on my personal primary. I think that also, this is something I've been doing over the last couple of months to a very big degree, is understanding my debt portfolio-wide on my investment portfolio, understanding where I have a very short term ahead of me. As Tony said, less than 10 years left on the mortgage, you probably don't do anything. And the reason for that is because the payment that I make is almost all paying down the principal. There's very little of that payment that is actually going to interest. So when I'm trying to refinance to get a lower interest payment, I'm not actually moving the needle very much. And there's a cost to doing refinance between the appraisal and the title and the lender fees, et cetera. So it doesn't really make sense. But on my investment properties, I've advocated and recommended on this call before that we should be looking at our investment properties as an opportunity to drive and create more liquidity in our own personal portfolio, so that if there's an opportunity to purchase real estate in the future that is particularly compelling, this is a moment to have access to that liquidity. So the access to that liquidity might come in the form of a line of credit, which is interesting, and the interest rate on the line of credit probably is not quite as attractive as the one that Tony just described on his primary residence. But another tool would be to do a cash out refinance of your investment property. Now, that's a tricky one to consider because I may owe $200,000 on an investment property at 4% interest. When I do a cash out refinance, now maybe I owe $300,000, but I'm paying 3% or 3.5% on $300,000, which ends up costing me more money than 4% at $200,000. So the reason why I might do that is because that additional $100,000 that I found, I'm going to go make an investment somewhere on that. And that investment might get me better than a 3 or 4% return on investment. Hopefully it'll give me 10 or 12 over the long term. But I think that the commentary on this as a whole is when you have an opportunity to capture fixed long-term debt, that's 30-year debt, that's less than 4%, less than 3%, that's something that you really need to pay attention to and understand where it can be of value. And I'm going to bring that back into the conversation because we're going to talk about a portfolio review tool that we've created here at Atlas. And one of the things that we'll do is we'll look at the interest rate on an investment property. And when we do the review of that investment property, we might say, hey, this is a great investment property, but Mr. and Mrs. Client, our recommendation is that you do a refinance because interest rates have gone down and that's just found money for you. So we'll come back to that theme a little bit, but that's the current environment on interest rates. And I think that the other comment, the final comment that I'll make on interest rates is that we're in a moment from a macroeconomic standpoint wherein our government, the Federal Reserve, Treasury, all the rest, is doing a lot to add fuel to the economy. So what I mean by that is they're printing money, essentially. They're making money more available to all of us to help stave off this difficulty of the current pandemic. Traditionally, what that means is that in the future, because we've added more money to the economy, we'll see more inflation in the future. And with higher inflation, traditionally comes higher interest rates. Now, every time it's a little bit different. This last go around in 2008, I thought that we were going to see much higher inflation and higher interest rates come 2014 because of all the monetary supply and policy that was inputted into the economy. I was incorrect on that, so I don't pretend to have the right answer on this. But if you study, and I do enjoy studying the history of economics, that's one that usually has a correlation, that when you print a lot of money, it leads to higher interest rates and higher inflation. If that's the case, all the more reason that right now, when interest rates are quite low, that I secure them in at a very, very low rate for as long as possible. So that's the thought process there. One more comment on the general economy. We just talked about collections being pretty good. We just talked about leasing being pretty good. We have low interest rates. There's something that doesn't quite fit here. You know, things are tough in the streets, but I thought they'd be a lot tougher right now. 30 million people unemployed and really a lot of weakness on a macroeconomic level. That's being propped up very aggressively through all the measures that we just talked about. But to me, there feels like there's something that's not settled. And that makes me curious to see what the next iteration will bring. What will the next months, what will 6 months from now look like? Will we be through this and back to normal, or will it be considerably worse as a result of everything that's happening? Next thing that I have here is I'd like to talk a little bit about our portfolio evaluation tool. Tony, before I do that, any questions or thoughts that I should be aware of, or can I keep on driving forward?
Well, I'll just remind people you can enter your questions at the bottom of the screen. If you have any questions that come up through the presentation here or something that's been on your mind since we were together last, go ahead and type that in the Q&A and we'll get to those toward the end of the webinar.
Great, so I'm going to share my screen, and this is a tool that Atlas has created. It's been about 6 or maybe a little bit longer, 6 months ago or something like that. And the purpose of this tool is to understand each individual property that we might own, put them on a stack so that we can understand how they're performing on a relative basis, and then determine, based on what this property is all about today, does it make sense for me to continue to own this property, to refinance the property, to do renovations on the property so I can capture higher rents, to sell the property and maybe buy a new one because I'll get a better investment return, as well as a description of the property itself, a mental game of what's happening in this neighborhood today, okay? Maybe I bought a property 5 years ago in a neighborhood that felt like it was on the fringe, and development has really come to it, and now it's an amazing property that's appreciated really aggressively, but the next 5 years doesn't promise that next appreciation story. So it's going to have standard appreciation, but not accelerated appreciation. So maybe this will help us understand that a little bit. So on the screen here, we have a property which is 3316 Newton Street. Tony, are you familiar with that address?
I am, Ryan. That's a great little house.
All right, good.
So I bought this property in 2017. Ryan Boykin told me I probably shouldn't. And I don't know if you remember that phone call, but this is actually next door to my primary residence. And yeah, so this one's mine. This will be an interesting one to go through.
All right, great. Well, to be fair, I don't know that I said you probably shouldn't. What I said was it's always a good idea to buy real estate. And I might, if I didn't have endless amounts of money, I might choose to buy a different one. But
yes,
I think this is still a great investment property, and you bought it 3 years ago, and I think it's appreciated well. Tony, do you have a sense of what the value of this property might be today?
Stuff in the neighborhood that's similar is probably going to sell in the fours, mid fours probably.
All right.
Yeah.
Well, that's good because he said mid fours and my analysis was 450. We did not pregame this. Okay. I was hoping he wasn't going to say like, 700 grand. This is going to look very different. So he bought the property for $330,000. We just did an analysis this morning and came up with the current value of the asset for $450,000. His original loan was around $250,000. I don't know if this is completely accurate. I got it from public records because when we do these portfolio evaluations, one of the things that we're thinking about is the time that our client needs to invest into doing this project. We want to limit that time as much as possible. So we're going to do our first iteration with as much homework as we can do internally to make the process easy on our client, because we know that there's a lot of back and forth that happens here, and we're trying to make your life easier, but more financially successful and not harder. So original loan, $250. We couldn't determine his interest rate for sure, but we guessed that it was probably around that 4% rate for that time period. Tony, do you know what your interest rate might be on that property?
Yeah, it's probably, it's in the fours.
Okay, great. So we'll leave it at 4%, amortized over 30 years, original loan date, April 2017. His current loan balance, we put it on an amortization schedule to determine that if he was making regular payments, now he may have made extra payments, but if he's making regular payments, that means that his current loan balance would be $236,000. And his loan balance in 10 years will be down to $179,000. That's sort of a nice data point for us, but I won't go into it. His rents on the property are $2,100 per month, which is a great number. This is a simple home over in the Highlands neighborhood. And even though it's not a giant home, he can still get $2,100 a month because of its location. The Highlands neighborhood, of course, is very desirable. And this is about a block away from the Highland Square marketplace. So expense ratio is 31%. I'm not going to go into the weeds on this, but expense ratio is for every $1 that I make in rental income, how much of that dollar will go to the normal expenses, taxes, insurance, maintenance, your tenant turn costs, if there's an HOA. Doesn't include the debt. We have the debt quantified right here. This is just the expenses outside of the debt. So 31% is a good baseline number that we can start with, and we can look at his historical numbers and get an exact number, but that's a good, fair estimate. So what that means is that he is making $17,000 a year on this before he makes his debt payments. And after making his debt payments, he's going to have cash flow every year of $3,000. Now we have a recommendation of selling this property, and I'm gonna share why we would sell this property here in a moment. The big thing that we're looking at to begin with is the cap rate. And I'm not going to go into the specifics of what a cap rate is for those that do or don't know. But if you'd like to learn more about what a cap rate is and why it's important, reach out to your investment specialist. So we're saying that we can sell. We recommend selling, and primarily we're saying that just on a snapshot basis, based on the cash flow and the net operating income, the NOI that he's getting on this property. Basically what I'm saying is that for a property that's worth $450,000 today, I would want to see a little bit more cash flow than $3,000, okay? Now, when he bought the property back in 2017 at $330,000, his cash flow might have been a little bit, his picture may have looked a little bit better, okay? His cash flow was still $3,000 a month, but he's saying I'm getting $2,100 a month in rent on a $330,000 purchase. The good news is that his purchase price increased to $450,000. That's great appreciation. That's a great bet that he made. His cash flow probably didn't increase quite that much. I mean, he got appreciation of 33%. I don't think his cash flow went from $2,000 a month to $3,000 or $1,500 to $2,100. It probably moved from like $2,000 to $2,100. So when you see that kind of disparity, you might say, hey, this might be one where we can get a better cash flow picture. So basically, we outline the situation on this document, and we might have 20 properties on this. And from this document, we then are going to look at each project individually. So this is asset number 1. So I'll go to my individual property, and I have my asset number, so it plunks in number 1. And here's the property, 3316 Newton Street. Now, based on this, I can see everything in this column is what I just went through on the side-by-side view. Bought it for $330,000, it's worth $450,000. Here's the debt that he owes. If we were to sell the property, we'd have transaction costs of about 6.5%. He's got some equity in it. And right now, he's got monthly net cash flow of $319, okay? And basically what we do from here is we say, well, what if we took that property and we just renovated it? And by renovating it, we might get a higher rent. So in this case, I might say I'm doing $20,000 in renovations. And if I do that $20,000 in renovations, how much will my rent go up? Those are the two important items here. Well, on this particular property, and I know about the property because I've talked to Tony about it, that one's not going to work. If I spend $20,000 in renovations making this property better, I'm still only going to get a tiny additional amount of rent, okay? So that one doesn't really make sense to pursue at a big enough number because I'm only getting $84 in additional rent. So I'm going to say, hey, Tony, you've already gotten the most out of rent of this that you can get. Now, in some properties, we might look at them, and here's a good example. Let's say that he had a 2-bed, 1-bath that was renting for $1,400 a month, but it had a full unfinished basement. And I said, Tony, let's spend $25,000 making the full unfinished basement another bed and a bath so that we have a 3-bed, 2-bath home that now instead of getting $1,500 a month, we'll get $2,100 a month. Well, I get $600 more in income per month, which works out to be $7,000 a year, in exchange for only a $25,000 investment. That makes a lot of sense. That's where this one might resonate. The next opportunity that I'll look at for Tony is, what if we buy a new investment property and we do it unleveraged, okay? An unleveraged investment property. We say, let's just take the equity out that you have, and let's take all the risk out of the equation. Let's have no leverage at all. It's not my recommendation that he do this based on his station in life and what his financial goals are, because I know Tony. But for some people, let's say I'm 65 or 70 years old, it might make a lot of sense to say, I want to get rid of my debt. I want to get as much cash flow as I can because that's going to be my retirement income. And I don't want to take any risk associated with debt because debt is synonymous with risk. Well, in this case for Tony, we'd be buying a $184,000 property. Well, that's not realistic. There's no $184,000 property in the Denver market right now that can get us rents equal to $1,300 a month, which would be a 6 cap. And this is kind of what we would target in our investment category, that if we were spending $184 on the purchase, we would require rents of $1,300 in order to make sense of the investment. But that's not reality. So I got to say, okay, that one's not going to work. The one that I think is attractive is buying a new investment property with some leverage. Now, Tony has leverage right now. He's at 55 or 60% leverage. He's got debt of $236, and the value is $450. So he's got leverage right here. In this scenario, we take a similar amount of leverage. So we take his equity of the $184. We'd lever it so that we have a new purchase price of $526. And in buying that new $526 with the type of investment that we'd identified today and getting it rented out at the $3,800, that's what we would require in rents, we're going to be left with a picture wherein his new cash flow is $826 per month. His old cash flow was only $319. So what have we done here? We've taken no new money from Tony. We took the lazy equity that he had in Newton, and we said, we're going to sell that. It's going to cost us a little bit of money to sell it because when you sell a property, you have transaction costs. But we're going to 1031 exchange the value of that asset into a new property. And now you own a property that's worth $526,000 instead of the old property that was only worth $450,000. And now with the same money that you already had without creating any new money from your pocketbook, we're able to create new income for you of $826. And that new income means that found money is $500 a month. So what I asked Tony is, Tony, how hard is it for you to get a $500 a month raise at your job? And he says, I got a terrible job. That'll never happen. And so we've just created that $500 a month raise. That's the first iteration, as we have new cash flow. But let's look at the next iteration, which is, what does it look like to own a property that's going to appreciate with a $526,000 starting point instead of his current scenario? Well, if I put appreciation on this property and I say that this one's going to appreciate at 3% and our new one is going to appreciate at 3%, they all appreciate at 3%. Let's just call that a spade a spade. What is the value of the portfolio in 10 years? So in 10 years on this portfolio, if we do this route right here, we're in a situation where, look at this, our 10-year total value, $576,000 is his total equity value 10 years from now. Instead of, if he stays on his current pace, it's only $472,000. So in doing this exercise 10 years from now, we've created $100,000 in additional future value by virtue of what we did and just taking a property that performed good, but not to the Atlas standard, and putting it into the Atlas standard and seeing them light up and get to the $100,000, which in this case is almost a 25% additional return. So this is a tool that we use at Atlas. It's our portfolio evaluation. And if it's something that you have interest in, it's something that I do every year. I make a lot of decisions around it. And I think that right now is a particularly opportune moment to consider it. And let me tell you why. If you have a home, a single family home that is worth less than $550,000 or $600,000, the purchase and sale market for that home right now is very hot. I'm amazed at how hot it is, but we're in a very, very, very good market right now for less than $600,000 in the Colorado region. It's a little bit lower price point depending on where you are in Colorado, between Colorado Springs and Phoenix and what have you. Against that, you could sell an asset at its peak value, and then you take that money and buy a new investment asset. And I'm also seeing in this market right now that the investment marketplace is a little bit softer than it was. It's not as razor hot. And so I can go from a fully appreciated opportunity into one that shows embedded opportunity. And so that is an interesting moment to consider this. Now you're taking risk in doing this, and you got to analyze your goals, and we don't want to put you in a position that's not going to be as stable. There's so many considerations, but it's a thesis that we put out there. So if you're interested in this, be happy to talk with you about it, and that'll be an opportunity for you to reach out to one of our investment specialists, and we can go through the entire spreadsheet, what it looks like, and do the analysis for you. So I'll pause there. It's 9:30. We usually assume that we're going to go for about 30 minutes, Tony. So any thoughts, questions, comments?
Yeah, so if you don't already have a contact here at Atlas, you can email us at info@realatlas.com, and we will get you connected with someone who can walk through this same exercise with you. You know, Ryan, as we were walking through this, it just kind of feels like if you compare this to other asset classes that people own, the opportunity to rebalance just seems really important. And a lot of people are doing that right now. If you have money in the stock market or in other investments, you're looking at, where do I have opportunity to rebalance? Just comment a little bit on, is this kind of the rebalancing of the real estate portfolio?
I think that's exactly right. I want to know that my real estate portfolio is a great portfolio for the next 10, 20 years because we're long-term oriented. And I want to know that if I do nothing to it, it's probably going to work out just great. And I also want to understand what tools I have in my tool shed that I can easily call upon to make that portfolio better. And the operative word is the ease, as well as the expertise of that tool. And I think that's what we try to deliver with Atlas is let us do the thinking on this because we're living it every day and we can actually give commentary. Sometimes people get a little bit too cute with this process And that's not the intent. I mean, frankly, you need to have the expertise to understand, hey, if I sell this asset right now, I can go out there and buy a new one that's a 6% cap rate that's going to provide me with a much better return. And by the way, I got a 6 cap and I only put debt on it of 3.5%. That's a great spread. Okay, that's a spread between your mortgage cost and your cap rate. That's a nice, healthy spread, nicer than it was before. So many details on this, and I know that we'll have a flood of questions individually from folks that have specific questions about their portfolio and specifically what I've requested, and those are going to be deeper conversations.
That's great. I also think as we walked through this, I think one of the great values of doing this process with an investment advisor is really knowing the whole story. So Ryan knows my whole story. He knows why I bought this property. He knows what it means to me. And so it's just being able to get the numbers together is one piece. Being able to understand the rest of the story is another really important piece. And that's really helpful. Ryan, there are a couple of questions here I'm going to shoot your way, okay?
I'll do them rapid fire.
Any recommendations or advice between investing in single-family homes, condos, townhouses, or other asset classes right now?
I think that in general, I'm going to lean against anything that has an HOA. If it has an HOA, that just eats up all the return. It also reduces your amount of control and autonomy on what you want to do to the property. So generally speaking, I lean against HOAs, condos, townhomes. I carry those. Absent that, I'm looking at the full picture for what the returns are, what the path of development story is for that specific neighborhood and submarket.
Ryan, this one comes up on every webinar we have, so I'm just going to keep throwing it at you, which is, do I buy now or do I buy later?
Honestly, nobody here is going to be able to time the market. It's impossible. If you have capital and you want to invest money for the long term and you want to save money for retirement, your kid going to college, you're interested in developing long-term wealth, you buy. You can't play this game, oh, I'm going to wait and I'm going to see if it goes. People were sitting there saying that 2 months ago, and 2 months later, doesn't look like there's a much better buy opportunity. I just think that there's a dollar cost averaging exercise associated with, I know this model works. I'm going to be patient with it. I'm going to buy a property every year or a property every few years. And over a 10, 20-year period, I'm not going to get the timing perfectly right, but I'm going to have stable cash flow. It's going to get paid off, and I'm going to have a great return on investment over the long term.
Brian, what do you think is an attainable cap rate for multifamily B and C grade properties in Denver right now?
I think a 6% cap rate is attainable. I think that's a strong number. And I really hesitate to talk about cap rate because I know that a lot of people don't fully understand a cap rate. That's a commercial term associated with commercial real estate. We, of course, use it with our investments. But we believe that right now, if you invested 20 to 25% of your down payment money, 25% of the purchase price into an investment property, that I'm going to be able to show you a return on that equity of 8 to 12%. That return is going to be based on the cash flow that I generate for you, as well as how much I pay down the principal of your mortgage, okay? And that'll be done on a monthly basis based on the rents, paying expenses, cash flow, and the pay down of the mortgage. That translates right now to, around a 6 cap. I think that's attainable for B and C. Called 5.5 to 6.5 is the range.
That's really good. Ryan, do you think there's going to be more demand in light of record unemployment for Class C properties versus Class A and B?
I think Class A, particularly luxury Class A multifamily, has a reckoning coming. We've built a ton of it nationwide. We've built a ton of it in Phoenix and Denver and other associated markets. And those very high Class A luxury apartments are going to be a lot tougher. That's my personal opinion. I think that there is a flight in the longer term in a recessionary environment to Class C and to lower cost product. People are going to move from A to B to C. And there's also going to be an aggregation of families and roommates where you say, hey, maybe that 4-bed, 2-bath house actually becomes more attractive if it's in the right neighborhood, a working class neighborhood, or the right price point, because the person that's living there, he and his wife, they say, you know what, let's get another couple in here because we can consolidate and reduce our expenses. That's the trend that I envision on this.
Brian, there's been some news recently about these large institutions that own single-family homes for rent, and the fact that they're performing incredibly well right now. In fact, some are even entering new partnerships and doing build for rent. What are you seeing in that space, and is there going to be a flight to the suburbs in light of coronavirus?
It's way too early to say about the flight to the suburbs. I still think that people fundamentally crave the community and the culture that is created through an urban center. They also crave the other amenities and the infrastructure, the light rail, and the ability to get to the airport, these kinds of things. So I'm not there yet. I do think that generally speaking, the reason why some of these single family for rent institutional players are performing so well is because people are taking a step back and they're saying, what investment class is going to work in this new environment? And when you specifically, one, you might say real estate still works, but then you dissect real estate, you say, it's not retail, it's not restaurants, industrial, I don't know, it's all going to be these giant Amazon fulfillment centers, the normal industrial, that seems a little uncertain, it's not office. But you're like, wow, people are going to spend a lot more time in their homes. People are going to spend a lot more time caring for their homes and investing in them, and they're going to want them to look and feel a certain way. And people are going to be officing in their homes. So that's a flight towards this asset class that we participate in. And that goes back to the prior question of, is now the time to buy or not? Well, every reason that you can give me why it's not the time to buy, I can give you one that it is. And we can do this all day long. And there's a good one for why it is a good time to buy. The reality is we're going to be guessing. I pumped the brakes on purchasing more real estate to a great degree in 2014. From 2008 to 2014, load up, back up the dump truck, buy everything you can buy. 2014 forward, I've been very surgical. It's been great. Kept on buying some great assets. I made a mistake. I thought I was smarter than the market. I thought that, 2014, we're at this crazy peak. Look what I was buying in 2008 and 2009. The amount of money that I left on the table associated with my investments in real estate could have been much higher had I continued to buy at a big level from 2014 until today. So we can't be too smart for our own good.
Ryan, this has been a great webinar.
I'm not done. I got one more thing. I saw in the chat somebody asked what areas are good to look for investing in what cities. I didn't say this before. I didn't say this today, but I'm going to reiterate it. The Atlas investment thesis is built on three things. Number one, only buy real estate in a market that you believe is a 20-year market. What I mean by that is, if I ask myself, the real estate that I buy in Denver today, do I believe it will be worth more money 20 years from now? I don't know how much more, but how certain am I that it's going to be worth more money? Well, in the markets that Atlas participates in, I'm as high in certainty as I could ever be. I feel very certain. Now, other markets that I might be presented opportunities in, over the 20-year picture, I'm not so sure. It might be a coin flip on whether or not it's going to be worth more. If the market you're buying real estate in, you're not certain is going to be worth more 20 years from now, that's an economic discussion. End it, take it off the list. I don't care what cash flow represents. I don't care how good the opportunity looks. It's done. Without appreciation and a fundamentally sound economic environment, it's not something to purchase in. I hope people completely appreciate that. That's core. Second is cash flow. I must have cash flow. The amount of cash flow doesn't need to be a certain amount, but it needs to be enough such that when we have dips in the market, I can withstand those dips and stay in the game. We're being tested on that right now, and it's working out very well. And the third one is work with somebody that knows the city so well that they literally can describe any block, any intersection off the back of their hand without thinking about it, because they know exactly what's going on there. If they know the city that well, then they will understand how the city is breathing and developing and which corner is shrinking and which corner is going to grow, and by in that path of development of the growth, one concentric circle, two concentric circles around main and main, that enables you to capture better than normal appreciation. I think that's a big reason why we've had a lot of success there. And frankly, the fourth one, and sometimes I don't put enough emphasis on this, is damn good property management. If you don't have a property manager that knows their stuff and that owns real estate themselves, they really don't know what they're doing. And I think those are the things that make us a little bit special. I think it answers the question. I've been talking for 43 minutes. I'm always going long on this venue. It's on you, Tone.
I agree with you, Ryan. Damn good property management. I get asked regularly, isn't it really risky to own real estate? And my answer is always the same. If you manage it, yes, it's pretty risky. If we manage it, it takes a lot of that risk out of the game. So, and I also just want to shout out to our property management team who was again awarded Best Property Manager in Colorado 4 years in a row. And we released a press release on that this week. And man, that's just a testament to how hard our people work and how deeply they care about the work that they do. So huge shout out to our property management team. Way to go. Thank you. And if you don't currently have property managed by Atlas, you're missing out on a great experience and a great relationship with the property manager. So consider that as well. Everybody, thanks for joining today. We really appreciate you. We're grateful for your questions. We're grateful for your engagement. Thank you for the encouraging comments in the chat. And we are here to serve you in any way that we can. So thank you. Have a wonderful Memorial Day weekend.